Okay, guys, we're gonna make the dance start very soon. So when you're all ready. Okay, mute. Let me just pick up the host. Can you all hear me, please?
Yep.
Okay, excellent, excellent. So first of all, thank you
Yes.
everybody for joining. And like I said, little technical issue as it sometimes happens. So, but we can make a gentle start right now. I would like to welcome all of you into this webinar. So, thanks for that. So, we're going to talk about navigating the path to investor readiness and look at some key strategies for developers here. So, my name is Tony T. I'm the founder and CEO of Renewables in Africa. So, what we do is very simple: raise awareness about renewables energy in Africa and across the world. So if you're looking for more visibility, for some qualified leads and sales, so for your product, your service, your program, to the people that matter to you, that means your customer, we definitely can help. So I'd like to start by asking you one key question. What do you think is for you the biggest obstacle developers face when they are looking to secure investment for the project? So that's a question that I'd like you to find, to tell me. And feel free to keep this question in mind as we go through today's discussion, because it's going to be very, very valuable, and that's what you will find. And we're very fortunate today because we have a fantastic lineup of speakers. And then I have Ruben Muniswamy, so the CEO of Axel and Numeris, but I'm sure they're going to introduce themselves properly. Edna Mugambi and also Nathan, they're both working with Ruben. And later we're going to have a very special guest. So you may have seen that already, but for those of you who've not seen that just yet, it's Mr. Jeff Toll, who is the CEO of Lidera Green Power, and he'll be sharing valuable insight, throughout this webinar through a case study. But before we actually get started, so I have a short post survey that I'd like you to participate in, because it's good for us to understand, obviously, what is your understanding of the topic, right? And then we can gauge as well where we are, and we know how we can actually put together the insight that we have for you. So I'm just going to run the post survey right now, and I'll be really, really grateful if you can all participate into that. It's a short one. Yeah, it won't take too long. So if you can just, I've launched it just right now. So hopefully you are all able to see that. So can you first of all confirm to me you can see that? So Brian or maybe Ruben, and can you see it?
Yes.
Okay.
Can see
I
it.
will want and I will urge people to please, please, please participate into that. So there are the moment 30 of us in the room, and I'm sure that all of us can respond to that. I can see 4 or 5 people have already started to responding. 6 people, excellent, is climbing. I like it. So keep that coming, guys, because that is what we want to see. So 9 people, brilliant, excellent. So 10, yeah, 26, okay, 11, that's nice, brilliant. So it keeps. So I'm gonna keep it running for another minute, and we can stop it. So the first question, very simple: are you a developer, an investor, lender? You can pick and select, because it allows us to see who is in the room, and we can make sure that we can give you we can tailor the response accordingly. Because so far there's no lender. Okay, interesting. So how often are you working on financial model evaluation? Oh, 7 people said daily. That's actually quite interesting. Or occasionally as well. So okay. So that's interesting for you, Ruben. I'm sure you want to pick up on that later. And the third question is, does your company have the expertise required in financial modeling and valuation to meet its business needs? So I can see 10 people are saying yes there. So so other people say no. Okay, that's good. So I'm probably gonna leave it for another 30 seconds, and after that, I could we can stop it and move to the next part of the agenda. And but before we do that, I will obviously show you what the response is, and we can all see that. So I can see 20 people have participated, so which is good. And okay, so let me just stop you there, because like I said, we have a very interesting heavy agenda we want to cover, and I like to cover most of it. I can see yeah, a good 84% of people have participated in the poll survey, more than 20 people. Thank you. That's good to give us already an indication. So I'm just gonna stop it right now and share the results, right? And we can all see for our appreciation. Let me just stop it and share. let me see if you can see the result. Can you see the result? Yes? No?
Yep.
Yeah, I can see. Okay. So essentially what we're saying that 35% are developers, 9% investors, no lender in the room. Okay. So 39% a consultant, and then other 17%. And in terms of second question, how often would they look at financial model? For 36% would say daily. So that's quite that occasionally as well, 36%. So give us an understanding. So who is actually ahead? And then the third question was obviously, so would the company has expertise into that? So I can see 60% say yes. Okay, that's good to know. And then outsource 15%, not relevant 10%. Okay, excellent. Thank you very much. So that is a good basically good quick survey. So obviously I'm sure Ruben, Nathan, and Edna will pick up on that. But that was for me. I'm just gonna stop sharing now and then obviously park it away now. And that's all I wanted to see for now. So hopefully, Ruben, as I say, it gives you an understanding. So who is in the room, how often they're using it, and then yeah, whatever we can do with that. So let me not move to the next part of the agenda. Thank you very much for participating into that, because like I say, so we really need you to be proactive, because I know that you're here, you're giving us your time. We want to make sure that your time is valuable. So that's what we're very grateful. So what I'm going to move right now, it's to allow maybe our speakers to take a minute, no more than that, to introduce themselves, because I know that we started slightly later than what we initially planned. So maybe Ruben, Edna, and Nathan, if you can introduce yourself. So let's be obviously gentlemen here. So Edna gonna
Let's
go
go with
first,
Edna.
and then
Yeah.
we'll have Nathan, and then last but not the least, Ruben.
Thank you, Tony. Thank you very much for that. I would like to take this opportunity to welcome all the attendees to the webinar. We are very grateful that you have taken the time to join us here, and we hope that it's going to be a productive, time. My name is Edna Mugambi. I come from Nairobi, Kenya. I'm an analyst, valuation in financial modeling, and I am currently with Numeris, where I have been working for, I think, 8 months or so. It has been quite the experience, and I'm really looking forward to meeting you all and sharing a few insights from my time here. Thank you.
Excellent, brilliant, brilliant. Thank you very much for that, Edna. So I'm just going to go now with you, Nathan.
Thank you, Tony. And my name is Nathan. It's short for Seshadri Nathan Krishnan. And I've been with Axel Numerous for about, we've been collaborating for about 4 years now. And I'm the director for valuation at Numerous. By background, I'm a chartered accountant from India. I have a CFA charter holder, also alumni of Indian Institute of Management. And I worked on different kind of projects across the globe, covering 6 continents. I'm still waiting for a project in Antarctica. Thank you very much. And it's a pleasure to be here.
So who knows? We may be able to land it just for you today. So not a problem. Thank you very much for that, Nathan. Much appreciated. So last but not the least, Ruben.
Thank you, Tony, and thank you everyone for joining. This is exciting. I'm looking at the chat boxes. People from Netherlands, Nigeria, UK. It's very exciting. So thank you very much for your time. So everyone, my name is Ruben Nsomi. I'm based out of Mauritius. I'm the founder and CEO of Numeris. The adventure for Numeris started as from the beginning of this year, with Edna being our first recruit, but we're expanding very fast, and we'll talk more about that later on. My background, I'm a chartered accountant. I've been in the Big Four and non-Big Four space for about 10 years or so, and I also run Axel Inside, which is a regulated corporate finance house in Mauritius. And prior to setting up Axel Insights, I was with Ernst & Young Mauritius in the transaction advisory team, working on transactions across Africa, including valuation and financial modeling. So I'm very excited to be with you here today. Thanks, Tony.
So Ruben, so basically you made the jump. You left a very comfortable life just to tackle with entrepreneurship. So how mad are you?
No, I mean, look, you've got to have a little bit of craziness in your life, right? So that was getting out of the comfort zone, but no regrets in what we've been achieving so far.
Oh, thank you very much for that. Obviously, I'm sure people will love the chance to see that, but you and your team are doing an amazing job. So, having said that, I know Ruben, obviously, you wanted to give us a little bit of an understanding because we talked about investor readiness here, and such an important topic. And that obviously, we could see that a number of people in the room understand it, and other maybe not so much. I just wanted you to share a little bit more insight. And I know you have a couple presentation here you want to share with us so that you can give us a better understanding and then we can move forward and talk further.
Yeah, definitely. I think let's we'll talk a little bit about investor readiness. But before that, I think for the benefit of the audience, just introducing Numeris, because maybe a lot of us don't know, haven't heard about us. So I'll just run a couple of slides, Tony, and then we'll discuss more on the investor readiness.
I think you're
Why is
absolutely
it
right.
critical? Why is it critical for renewable energy, developers, infrastructure projects in general? But in this for today's session, we're going more specifically on renewable energy. So just a little bit about us. So Numeris, just for the audience, myself and Nathan have been collaborating for a while now. I think combined together, we would have worked on at least 100 valuations over Korea, and I've worked on at least and at least 10 to 15 financial model across infrastructure and non-infrastructure. And when I left EY, what we were seeing was a gap in the market in trying to, getting the right balance between pricing and value from a consulting perspective. The other thing, as a consultant, when we go on capital raise, or when clients in Africa approach us and we look at the quality of some of the work that has been done, and often we would, query as to, could you not have got that done by somebody else? And, it was all down to, well, we didn't have the funds to pay, the big four or the others. And I think, a lot of the projects also, a lot of the infrastructure gap is all around, are you able to have the right advisor set at the right price to assist you in that? And with that idea, we built up a strategy and a business model around, how can we be different and how can we help or be a very integral part of the development in Africa. I've always been passionate about Africa. We've been working on transactions in Africa for the last 10 years. And nothing gives me more pleasure than having a transaction closed, and especially on the development side. So what we've come up with Numeris is, how do we build an African team that's going to tackle African projects, and mostly around investor readiness, which is what we see as a critical gap here. So our mission is really to drive impactful change in Africa, by enabling what we say better decision making in terms of advising clients when they go on capital raise or exits. This is the mission we've set ourselves, and building a Pan-African team along that. And we've made it very deliberate that we only spend time and provide value to developers or clients that are to a large extent operating in the sectors that you see in front of us, clean energy, water and sanitation, agriculture, healthcare, education, logistics, affordable housing, financial services, waste management. And that all comes from research as to, if we're going to jump from 1.2 to 2.4, a billion population over the next 20, 30 years. The level of infrastructure development in Africa is just going to be significant. The level of project finance capital is just going to be significant. And we need, and every able party advisory firm needs to step up the game in order to support those developers and make sure that we reach the financial close as quickly as we can. So that's really our focus areas, which is why for now we are spending more time and energy in building resources around clean energy. This means increasing capacity building within our team, and so that we can provide even more sharper advice to our clients. In a nutshell, in terms of service offering, our focus compared to other advisory firms, not to dilute our focus we are here to focus on valuation and financial modeling for now. The valuation offering is really the plain vanilla one around business valuations, fairness opinions, IFRS valuations. And from a financial modeling perspective, it's really broken down into financial model build or financial model audit or review, as you would call. And we will get into training as from next year. You've already got to know the team, so don't want to talk too much about myself here. So we've got as I said earlier, the plan and the mission is to get as many talents on board. Very privileged to have Edna within us as our first recruit. We also have Kame, who's joining the webinar. I'm very happy that we've just got another recruit in South Africa, a very experienced senior financial modeler, that has 6 years of experience in the renewable energy space in South Africa, to join us as from next week. So this is really good, and we're building the team, and I think by next year we'll be at least in 3 to 4 countries in terms of people presence. In terms of our credentials, talking specifically about renewable energy, collectively in the team, we've worked across over 400 megawatts of projects across Mauritius, South Africa. In terms of valuation, as I said, myself and Nathan, we've worked across several valuation of projects, of businesses, a different life cycle. It gives us a lot of confidence that we are able, after getting all this being blessed with experience and in some of the firms we work, to be able to provide quality advice at an affordable price. So that's really what we're here to set.
Excellent. Thank you very much for that. I can see effectively there's a lot of experience in the team there. And then, by all means, as I say, as we going around in the webinar, so I'm sure some of you will have some questions, so pop them in the comment box, and then my colleague Brian will be able to read them later. Or if you are actually courageous enough, which we hope you are, so you'll be happy to ask the question in person, right? So we'll allow you to unmute yourself. But I think before we carry on, I think you wanted to talk more about investor readiness. And sorry for jumping the gun. We needed absolutely to get to understand Numeris a little better, Ruben. So let me allow you to continue.
Thanks. Yes, I think, and that was as you know, Tony, when we were discussing on the theme for today's webinar as to what would be the most fitting theme. And I think nothing comes better as a first theme to talk about investor readiness. And I go back to the Africa Energy Forum earlier this year in Barcelona. And when you walk around, what you see and what you hear is really capital providers being there, ready to invest money into projects. And the feedback that you get is there is no shortage of capital. There is this myth or misunderstanding that my project is not getting capital, so there's a shortage of capital. The reality, and there's enough research done in Africa that backs that there is no shortage of capital looking at African renewable energy projects. But in reality, there is a limited pipeline of bankable projects. Now, there's a big difference, between the two, of having a project and having a bankable project. And and investor readiness is really about walking, and I use the word walking very carefully here because it's a marathon. It's really project preparation from getting the idea to financial close. It's really going through that journey in addressing all these issues, risk, to be able to present a bankable project either to an equity investor or to a debt investor. And sometimes in the past, when we were talking to clients, the initial reaction would be, well, we've got the land, we've got the PPA, so we're good. No, you're not. Actually, this is only maybe 10% of the journey. Yes, you've got somewhere, but the reality on the ground is that there are a host of factors that could make it a red flag to an investor, even if you've achieved land acquisition and PPA signing. And more it's if you look at the stats, and I think we've heard that numbers many times, those who are in the renewable energy space or energy space in general, that's presently more than 600 million people in Africa don't have access to electricity. Now, just to make it interesting, when I was doing the research, it's as if you have all those countries combined on the pie chart. The entire population of Ethiopia, Nigeria, Sudan, Uganda, Kenya, South Africa, Tanzania, and DRC not having electricity. I mean, this is just outrageous. And we know that there are efforts being done in some countries, like in Rwanda or Kenya, near universal access, is on its way in a couple of years, by 2030 at least. But still, there are, with population growth, and that same number, 600 million, if you look at the stats, was the same number a couple of years ago. So we really need to accelerate the conversion of projects into bankable projects and to projects that actually can generate an impact for the population. And if you look at the amount of money that will be required, the amount of investment that will be required as per official data, historically, Africa has been attracting at least only 2% of global investment. If we want to achieve the climate goals that's been set out under the Paris Agreement, we'll have to triple capacity of solar farms and wind farms currently installed. And that would mean, attracting 200 billion plus until 2030 and another 265 billion beyond that. So the amount is just enormous, which means there is a critical need to help developers, equity funders, and lenders in trying to make sure that those projects get closed, because else we're not achieving or increasing the electrification rate in Africa. And that's why, again, investor readiness comes into play. If we want to attract that volume of money, getting the basics right becomes a more and more important thing. Now, I've extracted this chart from a very interesting study that was done by McKinsey back in 2020 around the Africa's infrastructure paradox. And what they did is they studied a number of those infrastructure projects. It includes renewable energy, it includes ports and others. But the conclusion was that 80% of infrastructure projects in Africa do not go beyond the business plan. And we're talking billions of dollars of projects here that are not making it to the business plan. And that's very important to take into account. And when they look at the survey and we talk to investors and all that, one of there are obviously many reasons why projects don't go beyond feasibility study. It could be due to regulation, political cycles, currency issues, and all that. But one of the reasons that was highlighted out of 6 reasons was a poor project preparation in terms of the feasibility study and the financial aspects of it. In that, in some cases, there was not enough work to be able to, show credibly to investors that the risk return profile of those projects, and that's where financial modeling becomes very important at the initial stage or at the development stage. Getting it right, getting it detailed, getting it to a granular level, stress testing it, trying to be able to adapt to each investor's request or lender's request, it becomes very important. Trying to be smart about the structuring in terms of debt equity, in terms of concessionary funding, becomes more and more important. And if we go beyond, general infrastructure, if we look at the latest report or survey was done by ETAF. ETAF is an investment platform that was launched by Irene, recently, and they look at all the projects that they received for financing. Only 20 of them got completed, so the rest was rejected, and 45% of it was rejected because of lack of project readiness and planning, but 25% was rejected because of poor offtake attractiveness and also the lack of financial structuring. And they highlight the importance of having detailed financial models that are able to present transparently and with robust sensitivity analysis to investors so that they can identify, so that we can assess their own appetite. So I think what we're seeing is, research over research and data that's just validating, why investor readiness, it was important before, but going forward with the amount of pressure that's being put on the continent to electrify quickly in order to so that economies can grow and businesses can grow, getting back to basics, remain the overarching theme here, in our perspective. Now, how do we support? I mean, at Numeris, we can assess on pre-bid modeling, post-bid modeling, valuation of projects, especially when you're raising capital at development level, assisting developers at financial close. Operational modeling normally comes post financial close and the project has been commissioned. Refinancing of existing projects requires also manipulation of Excel and financial model. And if you're a developer or a sponsor, there's generally or a fund that has acquired a stake into a project, and if you're reporting under IFRS, which most companies do, there's a need for regular valuations, depending on the sort of valuation or recognition policies you've adopted. And obviously, at some stage of maturity, or post-operation, there are, in some cases, discussions of exit. That's where we can also help as well. Having said that, all is not gloomy. Just want to reassure the audience that, if we look at a lot of the projects that have been successful, will have some of the mega projects, the renewable energy projects that have been live in Africa. I think it just shows that if you have the right approach and the right mindset and structure, you're able to get funding. But it all starts with, how do you approach your project development in the first place? And there's also a lot of initiatives. We're not going to put all of them here, but what's reassuring is over the years, you have a lot of external, help coming in through Get Invest or the Climate Investment Platform or even ETAF, and making sure that everyone's doing their bit to either provide financial advisory, either services or grants or technical assistance, or in some cases, matching projects with funders. All of that are just trying to help, or in some cases, helping or bankability assessments of projects. All of that in an effort to make sure that projects get funded quicker than it was before. I think just to close, there's no doubt that investor readiness is key, and on subsequent webinars we'll be going more into details around financial modeling and valuation of infrastructure projects. I think the formula for success, if we look at some of the projects we've worked on, and also some of the research that there is out there as to all the case studies you have out there as far as Africa is concerned. I think the first point is understanding that fundraising is a marathon, it's not a sprint. And if you want to rush it through, then more likely than not, you're going to reach financial close. I think the first step is, identify your bottlenecks and project risk very much in advance, even at pre-bid levels, and address them. Have a list of, have a comprehensive risk mitigation plan before you go to the market for funding. And that's where, successful projects are normally the ones that have, are well structured or well accompanied from day one. And it's not just financial modeling, there's also the legal aspects, there's also the technical aspects, the combination of support that developers take at the very beginning, and how they de-risk each and every hurdle or identified risk in the projects, whether it's around, do we have the right EPC partner, do we have the right technical supplier, is the PPA well structured in terms of hard currency, local currency. All of that are decisions that are taken collectively, normally at pre-bid modeling with your advisors. And at Numeris, we'll be happy, especially for those developers on this call, we'll be happy to support you on those projects if ever there is a need. Good. I think that's it from me. So, Tony, just a little bit of introduction around investor readiness, but again, to the audience, we'll be on the other webinars talking more into granular level as to how financial modeling in detail works on a project finance basis.
Thank you very much for that, Ruben. And I think information that you've shared here, so I'm hoping people in the room can realize it. This is fundamental. This is the reason why many of you can't raise money, can't approach investors, can't get their project to close. So listen to what Ruben is saying very carefully, because like I say, if you don't want to have, let's say, a nasty surprise later, it's better for you to have the insight right now to make sure that you address and do the right thing. And I'm just going to give you the opportunity to go a little further, so in a few minutes. But before we do that, let me just get a chance to run through a very quick Q&A, because I think we have Nathan and Edna as well here. But before I move into them, so just in the next minute or so, Ruben, very quickly, just rebounding on what you were just saying there. So from the experience that you've had, working for the Big Four and now setting up your firm that you're growing. So in financial modeling, what would you say are the key focus areas that lender pay attention to? And how can these be overcome? I know when we did the post survey, there were no lender here. So maybe you may want to give us some information about that, those key focus areas people need to look at.
Yeah. Definitely. I think I think that's a great question. It depends. Okay, first of all, you would approach it differently. It depends on, if you're talking to equity investors or debt investors. Because one is more mostly interested around your equity returns. I mean, both of them are looking at return, just to be very clear. But let's say that there is the ratios are different. That's a first difference. Lenders in particular when looking at pre-bid modeling, I mean, or even modeling at financial close, what's very important for them is our critical ratios like DSCR, which is our debt service coverage ratio. What's the DSCR like? And sometimes you would go into calls with lenders and they would say, okay, what's the DSCR? What's your average DSCR with a project on an annual basis? Typically, you're looking at least 1.2 times. So basically, it's how much cash are you generating, or the project is generating, that's able to service my debt. And that's what we, in some of the discussions we've had in the past, and also on the current projects we're working on, are some of the immediate metrics that we see. The focus is also around how the model is flexible and the ability to stress test the model from a lender's perspective. Often the case, it's the banker that'll take your model and own the model and run the sensitivity analysis. If it's not one that is flexible, it becomes critical, for them, because they're not going to rewrite, every single line, and that's in our experience that can lead to delays from an investment appraisal perspective. So typically, what we would do normally, we will build different scenarios or sensitivities and provide the lenders with some clarity as to where they can stress test any assumption in the model, so that they can see the resulting output. And that's very important. What's also important is about making sure, especially if you're building financial models for projects where you're borrowing in, let's say, hard currency, but your PPA pricing is in local currency. In some cases, investors would just want to make sure, or lenders just want to make sure that you factored in currency devaluations. How are you looking at how you're making sure that there is enough funding or currency devaluations to be taken into account in your model. And you would go into endless debates as to, well, we can't project the future. But the reality is that, especially in Africa, what we've seen is if your PPA is local currency, but your investment is generally in dollars, you'll have to run sensitivity analysis and really play God in some cases. For the equity investor's perspective, it will be mostly around your return profile, so your IRR, your payback, and all that. But mostly around, are your really focusing on where where the, what can hit the cash flows that can, increase the payback or reduce the return. You would typically, what we would do if as an investor looking for a model, we would, we're not going to review or recreate an entire model. We'll use the lender model and obviously just add a couple of, additional metrics for them. But yeah, I think in a nutshell, I mean, we have a detailed seminar that will go very much in details as to what lenders are looking for. But in a nutshell, that will be the main ones that we see in our discussions, Tony.
Excellent. Thank you very much for your extensive response, Ruben. Much appreciated. Nathan, I want to move to you because I was told before this meeting that you're actually the king of valuation with great experience both in the African continent but also in India, where you're currently based. And I have some question for you. So what, according to you, are the key elements when we talk about valuation here that we need to consider when we are raising capital or when we are exiting? What would you say there?
Yeah, thank you, Tony, and thank you for giving me a new name, King of Valuation.
King Nathan.
Yeah. So to address your question, right? So any valuation, business valuation or valuing anything, there are three broad approaches. One is the asset approach or the cost approach, where you value it at historical cost or estimate the cost and value it based on that. The second approach is the discounted cash flow approach or using income approaches. And the primary one is the discounted cash flow approach, where you forecast the future cash flows generated by a project and then discount it back to calculate essentially the net present value using a rate. And the basics of that is that the point of discounting would be to account for the time value of money that you have now is always better than the money that you get later, right? And this discount rate that you apply is where one of the key elements or multiple key elements come into play. So it would differ based on asset class, geography, development stages, offtake risks, degree of leverage. So meaning whether you have more debt or less debt, and the life of the asset, whether it's a 10-year asset, 30-year asset, or longer than that, right? So primarily this is correlated to all kinds of risk and what is the cost of capital prevailing in the market. And you can connect all this to what Ruben just explained earlier about the risk factors considered by lenders and as well as involved in the project. And this discount rate would be applied to cash flows, where we build a complex financial models that essentially includes and integrates all technical and financial parameters for the project. So the discounted cash flow valuations tend to be viewed as more accurate and more reliable only if the data for the project is also similarly available, reliable, and also considers many sensitivities and scenarios, like Ruben also explained earlier. And these also need to consider other potential variations. So what would happen if, say, the rate increases or down and it doesn't happen as fast as, say, whatever you plan for the base case. So all of these need to be incorporated into the model. And this would be probably the most or the best basis for valuing a project. A professionally done custom bespoke model considering multiple factors are always better than in quality than a template based model, and that always comes into play when evaluating these kind of projects. And the third method is using multiples, and there are different ways of looking at it. One is common for businesses as well as different projects. It would be AV by EBITDA. So look at the enterprise value, essentially the value of the project as a multiple of earnings before interest, depreciation, taxes, etc. And the other would be looking at it as a dollar-euro value per megawatt of project, depending on the type of projects. And these tend to be very high-level valuation. This is kind of a relative valuation method essentially you can easily compare it across multiple companies, projects, and uh, you'd consider, like I said, the different ways of how you structure your P&L and things like that. But the challenge always is to find a similar type of peers to compare against. So you look for things like same asset maturity, corporate cost structure, things like that. And these are usually very hard to find. But the limitation for this approach is anyway that your cost structure varies, financing structure varies, offtake agreements varies. Everything can be different for the same type of projects depending on how the contract is structured and things like that, right? And it's always given this limitation, it's always better to triangulate using multiple approaches to come up with a valuation for a running project. But valuing a project development pipeline, which is what essentially we are talking about, is slightly different, right? So the equity value is often calculated based on, say, $1 or euro per megawatt, depending on what stage it is. And we could also theoretically use different uh, scenarios and different stages in a DCF method and to reflect the risks attached. So you would attach a higher discount rate for a very early stage project, while an investment at ready to build project would be discounted at a slow, sort of lower rate. And sometimes we also build in, depending on the history of the particular jurisdiction, a chance of success percentage as well. And then it becomes more about how do you increase the chance of that success. So considering all this, there are multiple factors that go into this, and there are huge variations that can happen based on at what stage you're securing the site, permissions, grid connections, and offtake agreements, and multiple factors like that, right? So I mean, generally we call it as a project's premium, and therefore that can vary based on uh, these factors. And generally speaking, the development stage, availability of reliable data, and these tend to dictate the best means of valuing a project. And we often combine multiple methods to triangulate to value. And one last caveat before I leave with you is that it's important to remember that none of these capture unpredicted market fluctuations, which we have seen recently, right? So COVID, invasion of Ukraine, or other global events like that. So none of these accurately capture that. So those also tend to throw these models off whack, right? And finally, the quality of these projections also can be improved by de-risking some of these assumptions used. For instance, if it is a project funded using Forex, how do you hedge that? Or whether you're using fixed contracts, insurance. Those are some of the ways you would de-risk that, but that's an entirely different topic for, I guess, another day. So I will leave that at that with you, Tony.
Excellent. I think I'm very happy I asked you this question because, like I said, there's so many parameters that we need to take into account when responding to that. That, like I say, without somebody like you, it's difficult just to have the proper answer. Because most of the time, whether you own a business or you work in a business, we tend to value that much more at what it actually is, right? And need some time to come back to earth. And yeah, what you say is absolutely true. No matter how well you actually will you work on your model, you always have parameters that nobody could have planned. Like, for example, COVID, right? It's a typical example. So how much does it impact your business? Only God knows. So let me just move into the third question. I want to speak to Edna, because I think all of that, as we said. So Ruben, you were very good at sort of repainting the picture for us to understand exactly where we're evolving. We know that there's a global issue of climate change. Yes, people still deny that. I think we probably don't have time to discuss that today, but let's assume that we all believe in that. That's why we into this webinar. And then we need to mitigate the emissions that we are rejecting. One of it is obviously renewables energy, and that's why we have those projects. But the whole question of sustainability. So how much of it is a factor when we're looking at making renewable energy project investor ready? And I know, if obviously Nathan was the king of valuation, I know you, Edna, you're certainly the queen of sustainability. So maybe you can give us some insight there as well.
Thank you, Tony. That's a very good question. And I like that you've highlighted the sustainability person. I happen to be very passionate about the subject. So when it comes to renewable energy, when you consider sustainability factors, you need to think about it in terms of the three components of ESG. That should be the main thing whenever you think sustainability, which stands for environmental, social, and governance. So we need to look at each of them in turn so that you can figure out how to incorporate each of these aspects in your project. So when it comes to the E, the environmental aspect, let's go back to the bit where Tony mentioned climate change. So renewable energy projects are inherently focused on reducing carbon emissions and combating climate change. So that should be the main thing when it comes to your project. But when it comes to environmental concerns, it goes beyond generating clean energy. It touches on the entire lifespan of the project. So we need to think about how are we extracting the resources, how are we managing waste, and how are we managing impacts or minimizing impact on the environment. And that's a good thing because when we look at the sector focus as numerous, there is clean energy and there's also waste management. So you find that these things, they are all interlinked. So developers need to demonstrate environmental stewardship over the course of their project. So that includes strategies like sustainable sourcing of materials, minimizing land use impact, which is very important. And another one is ensuring that biodiversity is protected. So by actively addressing these concerns, the project will mitigate environmental risks, which could lead to delays or regulatory challenges or increased costs or sometimes cancellations. So ultimately, a project that puts these environmental concerns in mind becomes more attractive to investors who happen to be focused on long-term sustainability and climate resilience. So that's the E. Let's move on to the S, which is the social component. So this aspect revolves around the project's impact on communities and stakeholders. So investors look for projects that foster strong community relationships, create local jobs, and support social development. So developers need to demonstrate that they are socially conscious, and this is by engaging local communities, providing transparent communication, and last but not least, delivering tangible benefits, which is extremely important. So you need to make sure that you embed impact metrics, which you keep tracking, like local employment, improvement of infrastructure, and there's also including groups like women and the youth, because sustainability also includes creating a more equitable society, making sure that everybody has an equal opportunity to thrive. So if your project makes sure that you employ the youth, you provide adequate opportunities for improvement, and while you're designing whatever you're designing, it also incorporates the needs of, let's say, a group like women, that's going to make your project socially responsible. And this reduces the risk of, let's say, something like local opposition, and it enhances your social license to operate. You have support from the local communities where you're located, and it creates a positive brand image. So these factors will significantly reduce the risk of an investment. Now, on the other hand, if a project does not consider these social implications, they risk facing resistance, which can lead to costly delays or even cancellations, which again negatively impact investor returns. So the social aspect of ESG is extremely important. Now, finally, let's move on to the G, the governance factor. So strong governance structures are vital to ensuring that a renewable energy project operates efficiently, ethically, and in compliance with all regulatory requirements. So investors want to see clear governance practices, such as transparent reporting, accountability measures, and you need to demonstrate that your leadership is strong and is committed to ethical business practices. So examples of such practices will be having independent audits, clear decision-making process, and regular disclosures. Disclosures are very important because they show accountability, transparency, and integrity. You are a person who sticks with your word. Now, governance is a crucial aspect in managing risk like corruption and project delays or operational inefficiencies, which again will negatively impact investor returns. So if you have strong governance in your project, you give investors confidence that the funds that they have invested have been managed prudently and with integrity, which makes your project even more appealing. So as you can see, the things that I have talked about go beyond the land and the bankability and the PPA terms, but they are all factors that are extremely important. So whenever you think about your renewable energy project, think about E, the environmental factors, which go beyond reducing carbon emissions. You need to manage resources responsibly, and there's also waste and recycling. And there's S for social. You need to contribute to building positive community relationships. You can summarize that as the CSR aspect. The corporate social responsibility aspect is covered here. And then there's G for governance, which you must implement strong, transparent governance to ensure ethical and effective project management. So if you address each of these ESG components, your project now is not just aligned with sustainability goals, and it enhances your attractiveness to investors. Thank you, Tony.
Excellent, excellent. Edna, I think that was a great presentation. But I thought you were going to start ESG by saying the E stands for Edna, right? So, okay. So thanks for that. Like ESG definitely is one thing that you need to take into account. So as you could see here, we really have a team of heavy hitters here, right? So whether you talk about Ruben, Nathan, or Edna, like I say, what they're sharing is really deep. And I know that only with the short time that we have, it's almost impossible to cover everything. But obviously, these guys, what I can say, so usually if you want to talk to them, you got to pay for that, right? That's normal because those are valuable information. But what we wanted to do today specifically, so because you taking time to attend this webinar, I think what I've agreed with Ruben is like we were going to allow some of you with real projects who want to go a little bit deeper to have a one-on-one conversation with him. And if that's of an interest, so you will need to click on the link that my colleague Brian will paste in the comment box. That's just to schedule meeting. That's going to be on the 2nd of October. We already have the date, right? So go there. But again, as usual, if you're not serious about that, if you're not really interested, please do not waste their time. Their time is really, really valuable, and I really, really appreciate that. So that they wanted to do for you guys. Some of you have projects. Some of you want to go a little further. They want to share things in public. You can have one-on-one. So Brian, please drop the link in the comment box. And guys, like I say, first come, first serve. I think we have a maximum of 10 slots. If you come after that, that's too bad for you, right? And this is also going to be open for people that watch the recording. So that's it. But without going any further, I'd like to welcome our guest speaker. I'm really excited to have him. Like I say, we talk about heavy hitters. This is one of them. And I know we may have talked about, investor readiness, valuation, all of that. But what does it mean in terms of the real life, case study? So that's why we actually bring it to you today. Somebody who's live and breathe all of these questions, have been able to sort of factor that in the project that he's been running, is very close to. So I don't know if Jeff is here with us. I believe he is.
Here.
Yeah, so I've allowed him to unmute. So Jeff, can you hear me?
I can hear you. Good afternoon, everyone.
Yeah, Jeff, I can tell you that you're very famous. I have a very good friend of mine who mentioned that, oh, you're so lucky you managed to get hold of Jeff. So it's it's one of the colleagues. But like I said, Jeff, so we're very privileged to have you here, and then we absolutely value all the experience that you'll be able to gather so far. And I understand that you want to take us through a little case study where we can actually put into practice everything, all the good things that Ruben, Edna, and also Nathan have been able to share. If that's the case, so the floor is yours. I guess you have a presentation,
I'll be presenting.
Okay, brilliant.
Jeffrey, are you okay? Are you okay for I'll run through the slides. You just let me know when to move to the next one.
Sure.
Yeah, it's really we're really privileged to having you with us. So thank you again, Jeff, for being our guest speaker today.
Okay, so Ruben, whenever you're ready. Good.
There you are. Can you all see my screen?
Brilliant.
Excellent.
So briefly, my name is Jeff Tal. I'm originally from Mali in West Africa, and I've been based in Madagascar for 3 years now, running Lidera Green Power, which is a subsidiary of a Malagasy-owned group of companies called Groupe Filatex. So I'm based in the capital, Antananarivo. We have projects in 3 coastal cities of Madagascar, Tamatave, which is the main port on the eastern coast, Diego in the north, and Majunga in the east. Most people don't realize that Madagascar is the 4th biggest island on the planet. It's actually as large as France in terms of size. So these are big distances we're talking about, and that poses some logistical challenges, obviously, when we're developing our projects. So right now we have 6 megawatts in operation, spread out over these 3 cities. This was the phase 1 of our projects. And we are now developing phase 2 of the projects, which will take us from 6 megawatts total to 42 megawatts over these 3 cities. Now, in terms of readiness for investment, I would say just the basics. I'm sorry to say, just the basics have been a bit challenging for us. We were not timely in terms of getting audited accounts, for example, and this is very, very critical, for any lender to assess the risk in the business. We also, had a learning curve in terms of the environmental and social aspects. We are lucky enough that our lender for phase 1 is an institution called Renewable Energy Performance Platform, which is funded by the UK government. So they are structured in a way that they are able to make loans and then have CPs, and they help you, resolve those CPs. So you're able to, start working, constructing the plant, and start operations while you are still, resolving some of the issues that are critical for them. So it is not as stringent as, let's say, traditional commercial banking. And let me give you an example in terms of environmental and social. So obviously our own employees are declared, and we respect all the laws of Madagascar, and we make sure that they are, under safe conditions, etc., etc. But we did not initially extend that to our subcontractors. So on each of our sites, we have people who do the cleaning, who cut the grass, etc. And those people were, let's say, subcontractors. So we were not feeling as if they should be working under the same conditions as our own employees. But when our lender sent an auditor, it was in 2023, they obviously speak to everyone who is involved with the project. And after speaking with these, service providers, let's say, they came back to us and they said, these people are working for you either directly or indirectly. So you have to respect the full conditions that are expected, with your own employees. So then we had to find, let's say, in French, we say portage salarial. So we had to find a company that hires these service providers. We pay them every month. And then that company has to make sure that they have health insurance, that they have, retirement contributions, everything that our own employees are entitled to. So it is a process. and it is, allowing us to be, more ready, let's say, for phase 2, because phase 1, we're talking about a budget of less than $10 million. Phase 2 is more in the range of $50 to $60 million if you take everything into account, because it will involve also battery storage, etc. So obviously the banks will be less forgiving, if we are not able to tick all the boxes for that type of budget. Right now, we are only working for one client, which is the national utility called Jirama in Madagascar, which is responsible for both electricity and water. To sort of break out of that dependency, this year, we started exploring commercial and industrial projects. And we are now in advanced discussion with one company based in the capital that produces packaging equipment and is the biggest consumer of electricity, let's say the corporate entity that pays the most money to the national utility in terms of the electricity bills. And they are interested in doing a rooftop solar project with us. We are also in advanced negotiations with a company that is building a cement plant in Madagascar to be able to offer, both solar plant and a thermal plant for them for their captive usage. And this is like a new activity for us, this commercial and industrial activity. And we are, hopeful to get at least one or two signed clients and references in the Q1 of 2025. So at this stage, I'm very happy to answer some questions or clarify some points.
Excellent.
Thanks,
Thank
Jeff.
you very much for that, Jeff. So, okay, can you hear me, Jeff?
Yes, I can hear you well.
Okay, no, that is a great question. So let me just kick off with a very, let's say, easy, hopefully easy, a question for you. So did you encounter any particular issue when you were looking to fund this project? And I know, as obviously you're very experienced, so you know how to take it through. So how much did it? How much was it different in terms of the experience you putting together this project compared to how you were doing it at the beginning? So how knowing what to do right now in terms of investor readiness has changed the landscape for you and allow you to make it easier?
Yeah,
if it makes sense.
Yeah, I would say the number one lesson for us is that there is a traditional way to develop projects in terms of getting securing the land, getting the concession from the government, doing all the studies, including network studies, to make sure this intermittent energy that you want to put in the grid will not put the grid at risk of any blackouts, etc. Then going through a process of finding the right EPC. And this process, I would say, can take 18 months to 2 years, for the size of project that we are developing. And because of pressure from shareholders to do everything yesterday, we did not necessarily follow that order. And then when you try to, put I don't know if this expression works in English, but put the cow before the cart or something, you end up paying dearly for that. So you end up, delaying the project because you have to go back and do the studies that you didn't do when you're supposed to do them. You have to go back and finalize all the permits, etc., that would have been obtained earlier if you had followed the proper process and the timing, and you end up paying a lot more. So our phase 1 was delivered, let's say, significantly above budget because we didn't follow this traditional way of doing it. So all around the world, people have a certain way of developing these projects. It's not magic, it's not hidden information. And it's very important to follow all those steps and sort of resist the pressure from shareholders or from the Ministry of Energy, who is saying, okay, we need this in this city because there's an election coming up, so it needs to be inaugurated, etc. You end up paying very dearly if you listen to that type of injunction and you deviate from the orthodox way of developing projects.
I think I know exactly what you're talking about, Jeff. Working and dealing with a number of developers. For example, in Mozambique, they have an election early next month, so we know exactly what we're talking about. So this is the time for me to say, if there is any burning questions to any of the speakers, it could be Jeff. That was excellent. Thank you very much. We're so happy you were here. Or to Ruben, Edna, or Nathan, to let us know, because I think we're running a little bit behind time here, but we can take 1 or 2 questions. And I would say, to make it faster, if somebody courageous enough, just raise your hand. We can give you the open the mic for you. You can ask a question, but make it short, guys. So that I like to take 2 questions, potentially 3. But just to say, Ruben, you're going to be busy, because I think when I was looking, there was already 5 meetings booked with you. So there's only 5 slots left.
That's great.
Right?
That's great.
People that are hesitant, so make sure that I want to put Ruben in the position whereby he has to open up a second day. Yeah, so
Tony, before we move to question, I just want to thank Jeff very much for your time, Jeff. I really appreciate that, and also for the candidness. I don't think maybe people go to webinars and you've been very candid, and I think that's how it should be. Learn from your mistakes and move on. But you also, what you said also joins what I just said in my presentation, which is fundraising or bankability is a marathon, it's not a sprint, and you have to take it like that. So I appreciate that.
Excellent. I can see somebody is asking whether we're going to have access to the slide from Ruben. Yes, only if you ask questions.
Yes. Well, we're happy to share the presentation later on. Yeah.
Okay. So, Brian, do we have any burning question, please, that we can take on right now, very quickly? If yes, so I'll be surprised. I'm happy to see that most of the people are still here. It looks like what you were sharing, Ruben, Edna, Jeff, and Nathan was interesting. So I like to think so. So, is there any question that anybody want to? Brian, any question in the chat? I think there's lots of comments. I'm not able to see if there was any question.
Yeah, Tony.
Yeah, Pat. Okay.
Yeah, the only question that I can see here is someone is asking, my company deals with home systems, so I'm assuming it's solar home systems. So please, would you advise for this kind of business raising funds? Thanks.
Okay,
that
no
is
problem.
From Osman.
Osman, yeah, okay. I think, Pat, let me just get to you first. Okay, you can ask your question, Pat, and then come to Osman. Yeah, Pat, you're on.
Thank you, Tony, and thank you to the numerous team. Very informative and very insightful and key nuggets on these projects. My question is, I would like to know, you talk about project readiness. Have you got any thoughts about, post-project review, especially when it comes to modeling that and, to have a look at, how did the business case that was initially presented and it was actually banked and, executed, performed for 2 years. And if you have any insights on the review of relooking at that business case after that to see whether it actually met, with what was actually initially planned and targeted. And, what are some of the learnings or insights that you can share on something like that if it has been done? Because I think that's also sometimes where great business cases are presented and sanctioned. And when it comes to delivery, you're not gaining the same reward that you've actually initially anticipated. So I'd love to hear your thoughts on that.
Yeah, thank you, Pat. That's a great question.
Yeah, go on, Ruben.
Yeah, no, I think look, and I think Jeff also may intervene here because post development. But I think from my perspective, Pat, yeah, I think the key issue in renewable energy at development stage, and you're right, you tend to play God with predictions, and there's caveats everywhere all throughout the journey. your technical consultant will caveat the predictions of energy output. Everyone will caveat everything. And I think it's just so hard. The reality is just so hard to predict and to play God. So definitely what we've seen in the past, we've seen projects that have reached the financial close, and then the reality in terms of output do not materialize. And then, so I think so far as it's a question of genuineness in trying to find solutions, and that it was all based on good faith, and this is climate change issues affecting, for example, your solar irradiation output, which is beyond your control. Lenders and equity investors would be in a position to understand and find solution constructively, and it's always a question of being upfront about it and addressing it, rather than playing the blame game, is what I've seen in the past. But so long is defendable and it's to do with factors beyond your control, I think equity investors and lenders would normally look at that. The other thing as well is that all lenders mostly will be monitoring, and the monitoring is not just on the financial aspects; it's also in some cases, as Jeff would be looking at, the ESG aspect. You were promising this in terms of your ESG projections. How are you doing on that? And if you haven't been doing or haven't been a good student, I think obviously you need to step up the game, because some of those covenants sometimes are linked to, some of them have quite strict covenants in terms of meeting those ESG targets within a certain period of time, if that makes sense.
Excellent.
Maybe Jeff, I don't know, it would be good maybe to share your experience. What was pre-projection and post-operation, if you have any anecdote to share?
Yeah. I mean, in general, in terms of execution, the risk is relatively limited with solar. From a mechanical engineering, electrical engineering, it's very simple. Nothing moves. There are no lubricants. You build it and it's there for 20 years producing. As long as you work with a reputable EPC, generally we don't get many surprises on that front. The areas to monitor more closely are the cash flow issues. Is the client paying you on time? Are there any issues with the disputes over the billing, etc., etc.? But in terms of delivering and operations, it is the simplest business I've ever worked in.
Excellent. Thank you very much for that, Jeff. I think now people are sort of waking up, but we just have, listen, guys. So if you can't, we're gonna be able to screen me one, potentially two other questions. I have Tom, I have Olabisi, and I have Osman. I think it's Lolo as well. But listen, what we're gonna do, I think I'm just gonna take a couple of questions, and after that, we can close and carry on with questions that you can send to us. We will see. So let me, I think, is Osman still around? Because I think he was asking a question. Osman, if you can make it quick, please. And then I'll go to Tom and Lolo and we will close it there. So let me also say, if that's okay for you guys, so I'm asking for indulgence here. We may be 5, potentially 10 minutes late, yeah? So if that's okay, but if anybody needs to leave, for example, Jeff, I know that you probably tight time, that's okay. Just because I want to accommodate some key questions here, yeah? So, but guys, trying to make it tight. So, Osman, please, short and succinct, yeah?
Thank you, Tony, for the opportunity. So basically, I have a company that deals with solar home systems and solar for productive use. So these are smaller products, but then you still need finance to finance the business before the business can succeed. So I'm just asking the questions, how do you raise funds for this kind of business?
So how do you raise funds for a small business like solar home system?
Exactly.
Okay. Where are you based, if I may ask?
I'm based in Sierra Leone.
Okay. All right. Look, and obviously your customer base is residential, right? So you're and does it work like in Kenya, for example, you would be topping up every now and then
Exactly.
for a better element, yeah.
Pay as you go, exactly.
Okay, excellent. Look, I think there's a lot of capital providers, out there. As a matter of fact, if you're in the solar host systems, you need to be in Nairobi in 2 weeks' time, because you're going to have the Google event, which is the largest off-grid event in Africa, where all the investors are going to be there, and obviously a lot of your competitors potentially as well. But again, if you look at Kenya, the amount of money that has been injected into solar home systems, so the money, there are definitely investors that are interested or that are looking at that area. But again, it's all a question of how robust is your business model, and it goes back again to what investors will be looking at is no different. Obviously, you don't have the land issue and all that, but it's also around your default rates in solar home system. How do you make sure that your business model, in some cases, in projects that I've seen, the moment the customer doesn't pay, there's no light, so there's an incentive for them to make sure that there's payment being done on time. And sometimes the use of technology is quite interesting in making sure that it's billed and money is collected almost instantly. So I think I don't know the exact business case, and we can't discuss that we don't have enough time to discuss it to the specifics. But my point to you is that there is money for solar home systems. I think the reality on the ground is that lenders and stakeholders have come to the fact that the entire African population cannot be grid connected. It's not possible. There will be more mini-grid upgrade opportunities out there, and you just need to make sure that you've addressed the bankability issues, the default rates, how you're handling your collections, and also making sure that you get the pricing right. That's, I think, the first fundamental thing. If your pricing is not as great as your competitors, unlikely that people will switch to you as that. Yeah.
Okay, so let's go to Tom. I think Lolo sort of disappeared. That's fine. But I would say after Lolo, I won't take any more questions. If there are questions, that's the opportunity for you just to book a one-to-one meeting with Ruben, and you may get an hour of him advising you, right, as opposed to just squeezing a 30-second response here. So Tom, I'm allowing you to unmute. Normally, you should be able to unmute. If you can unmute now and speak, please. I know Tom very well, by the way, so he's a very good friend. Tom, you on?
Yes, hi, Tony. Thank you so much. Interesting discussion. I'm a developer. I'm based in the UK, but I have projects originally from East Africa. I have projects in West Africa and the Caribbean. My question is to Nathan, valuation guru. Now, there's a gray area as a developer on the issue of developer fee. Is there a rule of thumb or a metrics used for calculating this? Because there's a huge variation on offers coming from this left, right, and center without a laid down rule. It's either per megawatt installed or a percentage. I'd like you to elaborate on that. That's my monkey wrench on the discussion.
Thank you, Tom, for that interesting question. See, developer fee, or for that matter, any other parameter that you need to evaluate based on a project where there are multiple variables like this, right? Everyone tends to use rules of thumb, and half or more than half the time they are always wrong, right? My suggestion with this limited amount of time that we have is you probably need to model it out and look at probably the multiple parameters that are involved before you take a call on that. And Ruben, if you have anything to add, I will also let you speak.
Yeah, thanks. No, Nathan, you're right. I think it's a question as which stage you are. If you've done, if you've taken a project from an idea to bid to close to PPA and all that stuff, obviously there's some value that you're bringing and time and energy that you've spent that the equity investor coming on board is not. Is getting it free of charge in a way. So obviously, in some cases, we have seen development premium in the past, but I've also seen some outrageous development premiums in the past as well, which also discourages equity investors because they're not reasonable. I think it's a question of stage as to where you are. If you're coming up with a project and you've got just the land and you're asking somebody for a development premium, I don't think that's reasonable. I think it's too early. You need to move to quite an advanced stage to be able to argue that point, and make it a convincing argument.
Excellent, excellent. Thank you very much for that, Ruben. I think we're gonna come call it to a close. I would say if there's some more questions that people want to ask, like I say, please take the chance to book a one-to-one meeting with Ruben, and you can go through that. But do not worry, because we're gonna have some other webinars where we can also explore this topic a little bit more into details. So let me just take the chance here just to wrap it up for all of us, if that's okay. But before I do that, I think why I'm doing that actually. So I like to get some post survey for you, just exit survey, right? We want to find out. So what is your impression of the webinar? So if there's anything that you would like us to improve, so that would be good. So again, it's a very quick question here. So what is your assessment of the webinar content? So the format, did you like it, not like it, and then overall, did you appreciate that? And it's good for us because it allowed us to see what you are thinking about those topics that we bring forward, and allowed us as well to make sure that we can shape something that is much more in tune with what you're expecting and move that forward. So I'm just going to allow you to vote for another 30 seconds. And while you're doing that, I just want to take the chance here to obviously kindly thank all our speakers. So Ruben, Edna, Nathan, but also the excellent Jeff. I think you've been really terrific in bringing your insights, your experience, and I think everybody here appreciate that. I think a number of people have voted, like I say, so they've given great thumbs up. I'm just going to stop it right now. Maybe some have not voted yet. That's fine. I think we have a good 15 that give us an indication of where we are. So I think that we like to respect them. Just share the result here. You could quickly see. So it looks like it was either voted either good or very good for the content. So same thing for format, good or very good, and same thing as well for the overall. It looks like you were really happy, so that's great. We love it. If there's some people obviously had a couple of negative feedback, please, we really value that as much as the good feedback as well, because we like to make sure that we keep on improving and we keep on serving you and bringing you value for money. So I'm just gonna obviously wrap it up just right now. Remind you that please do not forget to subscribe to our various platforms, social media. So our LinkedIn, our YouTube, especially our YouTube, guys. So please subscribe to all to our channel. I think you will see Brian pasted the link there. So if not, he may be doing that again. And don't forget, I think there's still a couple of slots left to talk to Ruben if you want to. So Ruben, Nathan, Edna, and Jeff, so thank you very much for all the time, for sharing your valuable insight. And I hope the session has given you tools, but also strategies that you need to make your project investor ready for everybody attended. And before I wrap up again, I want to talk about the exclusive opportunity that Ruben has mentioned, limited one-to-one conversation. Because like I said, this is a chance for you to speak to somebody who's experienced and have it up for free. Yeah, and go a little more in depth, right? So you can personalize your advice that you're receiving and also take your project to the next level. So as I said, there were just 10 slots, first come, first serve. And then, make sure that you book it quickly. So thank you all of you for joining us today. So we're looking forward to seeing you at future events. And I think what we're going to do, like we usually do, we like to finish in music, but everybody else, thank you very much. And we'll see you next time.
Thank you.
Take care.
Thank
Bye-bye.
you, Johnny. Thank you, Jeff. Thank you, everyone. Bye-bye.
Bye.